So, you have decided to move to another country. The offer looks better, the street seems safer, the apartment is brighter, and your future appears to have more room in it. Friends send photos from cafes, coworkers talk about higher salaries, and every successful migrant story makes the decision look less like a risk and more like an upgrade. Then the private calculation begins. The salary may start next month, but the deposit is due this week. You may need to pay for flights, temporary housing, documents, insurance, furniture, and several weeks of life before the first paycheck arrives. A qualification that took years to earn may not transfer immediately. A partner may need months to find work. For a while, you can be paying to leave one life while paying to build another. In a professional relocation, a planning budget of $12,000 can disappear before the move begins producing any benefit. That does not mean the move failed. It means the first year of higher savings may be spent rebuilding the money required to reach the opportunity. Still, some people recover that cost quickly. They enter stronger labor markets, increase their monthly surplus, gain local experience, and create options that were difficult to access at home. So what separates a move that expands your financial life from one that simply relocates your expenses? The answer is not just salary. It is the system underneath it. Timing, housing, taxes, work rights, family income, emergency cash, and how long the advantage survives. That is where the real economics begin. The first question is not whether the new salary is larger. It is whether the move improves the part of your income that remains after life has been paid for. That distinction explains why moving abroad can be genuinely valuable. A stronger labor market may offer better pay, faster promotion, safer employment, or access to industries that barely exist at home. A cheaper destination may create the opposite advantage: similar income with lower housing and daily costs. Some people move for both, higher earnings today and a wider career ladder tomorrow. The World Bank's migration framework emphasizes that the largest gains tend to appear when a person's skills closely match the needs of the destination, and when they have secure, formal access to work. But entering that opportunity requires capital. An employer-supported solo move might leave you paying mainly for documents, luggage, and a few weeks of setup. A self-funded professional relocation can require a planning reserve of roughly $8,000 to $15,000. A couple or family may need $15,000 to $30,000 once larger housing, multiple flights, school arrangements, and a longer transition are included. These are not universal averages. They are planning scenarios, and the destination can move them sharply in either direction. The low-cost version also depends on what the employer covers. A paid flight helps, but not if the worker must still fund a deposit, local transport, and weeks of food before payroll begins. A reimbursement arriving in month 2 cannot pay a landlord demanding money on day 1. The cost is also rarely one clean payment. It behaves more like a row of dominoes. A delayed work permit postpones income. The postponed income extends temporary housing. Temporary housing prevents you from signing a cheaper long-term lease. The expensive lease consumes the emergency fund. Suddenly, a delay that looked administrative has become a cash flow problem. The same chain can work positively. Recognized qualifications lead to earlier employment. Earlier income shortens temporary housing and protects the reserve. A protected reserve prevents expensive borrowing. Several ordinary events, connected in the right order, can be worth more than one dramatic salary increase. Now consider Sophia, a fictional composite based on a typical professional move. She's 31, works in data operations, and has accepted a position abroad that appears to increase her monthly take-home pay from $3,200 to $5,400. On the screen, that looks like a $2,200 monthly upgrade. It is not. At home, Sophia spent $2,400 a month and saved $800. In the new city, Rent is $1,000 higher. Transport, insurance, and utilities add another $400. Groceries and ordinary social life cost $200 more. Her new monthly spending reaches $4,000, leaving a surplus of $1,400. The salary improved by $2,200, but her actual financial position improved by only $600 a month, because the correct comparison is not old salary against new salary. It is old surplus against new surplus. That $600 is the engine of the move. It is the amount available to repay the cost of getting there. Suppose Sophia spends $12,000 on flights, deposits, temporary accommodation, documents, basic furniture, and 4 weeks without income. At an additional $600 of monthly surplus, the move takes 20 months just to recover its starting cost. Until then, her bank balance may look larger each payday, while her total financial position is still catching up. This is not a bad result. It is simply a slower one than the salary offer suggested, and the calculation can improve. After 6 months, Sophia moves from temporary accommodation into a shared apartment, reducing rent by $350. Her new surplus rises from $1,400 to $1,750, which means the move is now improving her position by $950 a month compared with life at home. The remaining setup cost is recovered faster. A small housing decision has changed the entire economic story. That is the success mechanism. Not relocation by itself, but a repeatable monthly advantage. Think of the starting cost as a hole dug before the first paycheck. A higher salary does not fill it automatically. Only the extra surplus poured into that hole each month does. Once the hole is filled, the same surplus begins building savings rather than repairing the past. Sophia's first sign of success is not the impressive salary notification. It is a quiet Sunday morning 14 months later when her emergency balance finally returns to the level it held before she bought the flight. She has not become wealthy. She has simply reached the point where the move stops consuming old resources and begins creating new ones. There is another layer. During those months, Sophia gains local experience, references, and contacts. She learns how employers in the new market hire, what skills receive better pay, and which qualifications actually matter. These benefits do not appear as cash immediately, but they can expand her future options. This is especially important because foreign qualifications do not always translate cleanly. OECD data show that highly educated immigrants are more likely than native-born workers to be overqualified or outside employment, while host country education substantially narrows that gap in many places. That makes early career decisions surprisingly important. Taking any available job may protect cash flow, but remaining too long in work below your skill level can weaken the salary growth that justified the move. The strongest version often combines short-term flexibility with a deliberate route back towards the person's actual profession. This is why reasonable people accept a difficult first year. They are not always purchasing immediate comfort. They may be purchasing access to a more stable currency, a deeper job market, stronger institutions, better education for children, or simply more control over the next decade. Those benefits are real, even when they cannot be reduced to a neat dollar figure. If you enjoy seeing how ordinary life decisions work beneath the headline number, subscribe to Life Cost Decoder. The visible promise may start the decision, but the hidden mechanism determines whether it creates value. By this point, Sophia's move appears to work. Her income is higher, her monthly surplus has improved, and the starting cost is being recovered. Yet the result still depends on one variable more important than the salary, the apartment, or even the original $12,000. The monthly advantage must survive long enough to finish the job. And survival, in this calculation, means durability. Two people can receive the same salary offer and produce completely different outcomes because the decisive number is not income. It is the monthly advantage that remains after housing, tax, transport, insurance, family obligations, and ordinary life. For Sophia, that advantage improved when she reduced her rent. Yet rent is only one moving part. A longer commute can return part of the saving to fuel and lost time. A cheaper apartment may require furniture, a larger deposit, or several weeks in temporary housing. Recent migrants often face greater housing strain than settled migrants, so the first available home is not always the financially strongest one. Then comes employment stability. If Sophia's right to remain or work is connected to one employer, a bad manager is no longer just an unpleasant Monday. Leaving may affect income, legal status, and the time available to find another position. The World Bank identifies formal labor access and the ability to change employers as important conditions for migrants to receive the full benefit of moving. For a couple, the hidden variable may be the second income. A budget built on two salaries can fail even when the primary worker earns exactly what was promised. If a partner needs language training, childcare, or license recognition before working, the household carries family-sized expenses on one paycheck. The reverse is equally powerful. Once the second income begins, much of it may become surplus because rent and utilities do not double. One delayed job can stretch break even. One successfully transferred career can shorten it dramatically. This is where success can begin compounding. Local experience makes Sophia easier for local employers to evaluate. References expand her network. Better knowledge of the market helps her recognize which skills command higher pay. If she later earns a promotion without allowing rent, dining, and subscriptions to rise at the same speed, the additional income increases the surplus instead of merely decorating the lifestyle. A second fictional comparison makes the mechanism clearer. George accepts a job paying $400 less than another offer, but chooses a city where his total monthly costs are $900 lower. His salary is smaller, yet his surplus is $500 larger. The glamorous offer wins the conversation. The cheaper operating system wins the bank balance. Now return to Sophia's numbers. Her move required a hypothetical $12,000 starting cost. For 6 months, her monthly position improved by $600, recovering $3,600. After changing housing, the improvement rose to $950. At that rate, the remaining $8,400 takes just under 9 more months to recover. Break-even, therefore, arrives around month 15, assuming her income and expenses remain stable. After that point, the same $950 no longer repairs the move. It becomes new financial progress. 12 further months could add approximately $11,400 before investment returns, emergencies, or future changes. If Sophia receives a promotion and protects most of the increase, the advantage can grow faster. That is an optimistic but credible version, not a forecast, and certainly not a promise. Real life usually edits the spreadsheet. Suppose her housing change is delayed by 3 months. A document renewal costs more than expected, and she sends money home during a family emergency. She responds by postponing a more expensive apartment and taking a short professional course recognized by local employers. Break-even may move from roughly 15 months to 20 or 22. The result is slower, but it can still be positive because the monthly advantage survives. This matters because migrants with foreign qualifications frequently struggle to work at their skill level. OECD data show that around 1/3 of highly educated immigrants across the OECD and European Union are overqualified for their jobs, while qualifications earned in the destination country substantially reduce the gap in many places. Language and unfamiliar institutions can also slow the conversion of existing skills into local earnings. A local course, license, or certification is therefore not automatically wasted spending. Under the right conditions, it can protect the income engine that justified the relocation. Only after seeing how the successful version works can we see how it weakens. The first major mistake is comparing salaries instead of complete financial positions. A person sees an extra $2,000 a month and assumes the move creates $24,000 a year. Higher tax, rent, insurance, and transport may reduce the true improvement to a few $100s. The expectation is understandable because salary is visible and expenses arrive separately. The consequence is a break-even period several times longer than expected. The second mistake is spending the entire reserve to create the finished lifestyle immediately. The new apartment, furniture, and car make the move feel complete, but they remove the cash designed to protect it. When a delayed paycheck, medical cost, or urgent flight appears, borrowing begins. Interest then consumes part of the monthly advantage, extending break-even again. Consider a difficult but realistic fictional scenario. Sophia loses her job during a rent increase and must make an emergency trip home. If she has preserved several months of expenses, the event interrupts progress. If she has no reserve and her work status depends on the employer, the same event threatens income, housing, and her ability to remain. The dream did not suddenly become foolish. The condition protecting it, time financed by cash, disappeared. So when does moving to another country create genuine economic value? It works when the destination rewards your usable skills, legal access to work is secure, housing does not absorb the salary gain, the household can survive the transition, and the monthly surplus remains positive long enough to repay the starting cost. A strong match between a migrant's skills and the destination's needs is central to the gains described by the World Bank's migration framework. It becomes financially weak when qualifications remain unusable. One employer controls too much of the outcome. Lifestyle costs rise with income, or the reserve disappears before stable earnings begin. Some people should delay the move, negotiate employer support, choose a cheaper city, or secure recognition of their profession first. That is not abandoning the opportunity. It is redesigning its economics. The bright apartment, airport photo, and larger salary notification from the beginning can all be real. You simply understand them differently now. The flight is not the moment the move succeeds. It is the moment the investment begins. A new country can expand your future, but only a durable surplus can pay for the journey. Would you still move after calculating the true starting cost and break-even period? Share the number that would decide it for you, and subscribe to Life Cost Decoder for the economics hidden inside ordinary adult decisions.